Hello, everyone. I'm Josh Stamer, Senior Managing Director with Foundation Source. I'm based in Orange County, California, and I lead the Western region for Foundation Source. Foundation Source is the nation's largest provider of specialized support services for family and corporate foundations. Today, we work with more than 2,000 foundations to help them bring their philanthropic visions to life through a combination of administrative, compliance, technology, and philanthropic advisory services. These capabilities allow philanthropists to focus on strategy and giving while having the knowledge that their foundations are running smoothly and compliantly. I'm excited about our topic today: strategic synergy, alternative investments, and private foundations. Like individual investors, private foundations are not one size fits all. In fact, we have a saying in our space that if you've seen one foundation, you've seen one foundation. Most people know that private foundations are the vehicle of choice for philanthropists who are looking for the most control and flexibility in achieving their goals in charitable giving. Private foundations are independent legal entities that retain full discretion in decision-making when it comes to grant making. They can leverage expenses in line with their mission. They run programs, they grant to individuals, they run scholarships, and retain full portability over their endowment. However, many important benefits to private foundations lie on the investment side. The two major themes of retaining full control and flexibility remain. However, more and more modern foundations are exploring and leveraging the benefits of non-traditional assets in their foundations. These strategies allow individuals, boards, and corporations to expand their mission, grow their asset base, and align a spirit of entrepreneurship within their foundation. Today, our session will focus on strategies and considerations that private foundations and those exploring a private foundation can consider specific to the area of non-traditional and alternative investments. Typically, non-traditional assets are investments other than cash, publicly traded securities, and bonds. These can include everything from tangible property, real estate, credit, cryptocurrency. However, the most commonly utilized tend to be hedge funds and private equity. I'm privileged today to be joined by two individuals who have a tremendous amount of experience and expertise in this space. Our first guest is Ben Durant, CIO and co-founder of Prevenio Capital, based in Newport Beach, California. Prevenio is an independent advisory firm that specializes in sourcing alternative investment strategies for wealthy families. Prior to Prevenio, Ben was CIO of a large single-family office and a director at ICG Advisors. Over the last 20 years, Ben has also worked as a trader for Morgan Stanley, Deutsche Bank, and Vantis Capital Management. Ben earned his BS in psychology from Tufts University and his MBA from Columbia Business School with a concentration in finance and international business. Ben, thank you for being with us today.
Happy to be here. Thanks, Josh.
Absolutely. Ben, if you would, please expand on my illustrious introduction of you and share a brief background on Prevenio.
Yeah, sure. I will be brief because you gave a pretty good overview there. So my partner, Kevin Murphy, and I started Prevenio Capital 6 years ago. The reason we started the firm was because in my time running a large single family office and networking with other large families, where you tend to spend a lot of time exchanging investment ideas and philosophies, almost invariably, those conversations revolved around alternative strategies. There were very few, if any, conversations around what are you doing in equities and bonds. And when we looked at the advisory landscape, most of the advisory firms out there, certainly the large wirehouses and many of the larger independent RIAs, tend to have a heavy focus on traditional asset classes such as equities and bonds. And so we saw an opportunity to launch a firm that would focus exclusively on sourcing alternative strategies, which is basically every asset class outside of stocks, bonds, and cash. So we started the business 6 years ago with about $100 million in assets. We've grown that to close to $1.5 billion in assets today, working with about 50 families.
Terrific. Thank you, Ben. And I know that while you and I go way back, you've had a terrific experience working with private foundations as well. So thank you for being here today again.
Yeah, and just to clarify, when I say 50 families, you know, many of those families have a foundation entity within them that we assist with.
Yep, absolutely. So our second panelist today is Jana Varicchio, Foundation Source's Legal Services Director based in Fairfield, Connecticut. Well, technically Jana's based in Lake Success, New York, but Foundation Source is based in Fairfield, Connecticut. And in her role at Foundation Source, Jana provides support to private foundations and their advisors on a range of issues, including grants to individuals, program-related investing, international grant making, scholarships and awards programs, and direct charitable activities. Typically for our clients who want to figure out a way to do something creative, Jana is our go-to. Jana collaborates with the company's foundation clients to develop and achieve their philanthropic goals while remaining in compliance with self-dealing, excess business holding, jeopardizing investments, and taxable expenditure rules. Prior to joining Foundation Source, Jana managed the foreclosure and bankruptcy department at a national financial services firm. Jana received a Bachelor of Science in Accounting from State University of New York at Old Westbury. She is a graduate of the Maurice A. Dean School of Law at Hofstra University, where she was an editor on the Hofstra Labor and Employment Law Journal. Jana, it's always a pleasure.
Thanks so much, Josh.
Absolutely. So we'll jump right in. Today we have a topic that I know many people are very interested in, exploring alternative investments within private foundations. To set the stage, let's talk a little bit about the most common investment classes and asset allocation within private foundations. Excuse me. And you can advance to the next slide. So according to Foundation Source's 2021 report on private foundation endowments, we see the 5 main asset classes to be cash, equities, fixed income, alternatives, and other. Other being life insurance, program-related investments, annuities, etc. One significant trend on our report is very specific to our topic today, alternative investments. We see that while the bulk of client foundation assets are made up of equities, as foundations grow in size, there's a significant increase in the utilization of alternatives, more so than any other asset class. Go ahead and advance to the next slide and we'll see what I'm talking about. Terrific. So Ben, I know this is a great segue into sharing your thoughts and a few slides that you have prepared as well. So why don't you go ahead and do so?
Sure. Okay, we can go to the next slide. And again, okay, so don't pay too much attention to all the verbiage here because I'm going to describe what we're talking about. So foundations that have traditionally had an equity and bond focus have benefited from a couple of pretty significant things. One is a 40-year bull market in bonds and fixed income assets. You know, if you go back to the late 80s when the 10-year yield was at 17% under Volcker, and you look at where we are today, even though we've had a little bit of a backup in rates, you've had a tremendous rally in fixed income assets that bond investors have enjoyed for almost 40 years. And over the last 15 years, we've had the greatest bull market ever in the equity market since the global financial crisis. And so you're traditionally allocated what we call 60-40, but it can certainly be a different allocation than that, but it's predominantly in equities and bonds, has performed extremely well over the last decade or two. However, if you think about the type of environment that we're going into now, and I think everybody wants to think about what the world looks like going forward, and if we want to focus on what foundations are trying to achieve, which is to maximize their power to give and also to preserve their capital and grow the corpus of the foundation over time, it's going to become necessary to utilize a higher degree of alternative investments to achieve those goals. If you go to the next slide, actually. Yeah, so if you look at the chart here on the top right, what it's really showing you is it's showing you the attribution of a 60-40 portfolio. The blue area is showing what you get from your bonds, and the sort of salmon pink area is showing you what you get from your equities. As you go back to even the sort of mid-90s, you were getting a really high degree of return from your bond exposure. And what the bond exposure was also giving you was giving you insulation during periods when the equity market was going through, dislocations and sell-offs. As I think we all know, as interest rates have trended lower and lower, the performance of a 60-40 portfolio has become very reliant on continued performance of the equity market. And as we're starting to see now, and this year's been a pretty good indication of that, you're actually in a situation now where volatility in the equity market is impacting your returns, and you're getting no insulation from your bond portfolio. And even more so, you're actually getting negatively impacted by a normalization in rates, which is affecting fixed income performance. If you go to the next slide. So one of the things we talk a lot to clients about is the level of uncertainty that we face going forward. The impact of the GFC and then COVID, and now the geopolitical issues we're seeing in Europe is creating a huge amount of uncertainty over what stage of the cycle we're actually in. And different asset classes tend to perform really differently depending upon what kind of environment we end up going into. You can make a pretty good argument that we're mid-cycle. I don't think anyone would say we're early cycle, but you can also make a pretty good argument that we're actually late cycle. And the moves that we've seen in inflation and the types of numbers that we're getting, I think the last inflation print was 8.5%. It puts us into a worrying situation where we could actually see a slowing economy with much higher levels of inflation, and therefore potentially a stagflationary environment, which is historically not good for equities and not good for bonds. Next slide. Okay, so when we think about asset allocation, the primary focus for us is how do we build a robust portfolio that's going to perform relatively well, regardless of what kind of economic regime we go into. And as I alluded to earlier, in those types of environments, the utilization of alternative strategies where there's a higher level of predictability and a less correlation to the markets, less reliant on market performance, less reliant on continued performance to fixed income assets to create reasonable risk-adjusted returns, which to us are in that, for a foundation, if we can generate, an 8 to 12% return over time with as little correlation to the market as possible, then we feel like we've done a pretty good job. So I know we're going to get into this more in the Q&A as well, but the overview here is increasing the utilization of alternatives within a foundation portfolio serves to protect the capital. It serves to insulate it from dislocations in the market. And via utilization within strategies like real estate, like private credit, like real assets, you can actually generate a yield on the portfolio that can achieve north of the 5% spending policy that most foundations face.
Terrific. Thank you, Ben. Very, very helpful. So, Jonna, shifting your way for a moment, as mentioned earlier, one of the most important services that Foundation Source provides for our clients is ensuring that they're able to achieve their foundation goals in a compliant manner. Alternative investments bring certain considerations that all foundations should be aware of. So let's talk through a few of those. First off, the big no-no in the expanded world of charitable giving is a phrase that we refer to as self-dealing. Talk a little bit, if you would, about self-dealing and why this is an important consideration specific to alternative investments.
Sure. So private foundations are permitted to invest in any type of asset. There are no prohibited asset classes, but there are prohibited transaction types. In particular, a private foundation is not allowed to engage in the transfer of assets, the sale, the borrowing of money, or really anything of a financial nature between itself and its insiders. So the easy insiders to identify are officers, directors, and close family members. But where it gets tricky is self-dealing also encompasses transactions with companies that are owned more than 35% by individuals who themselves are considered insiders. So when a foundation and an insider may be co-invested in an alternative asset, a hedge fund, some equities, anything like that, it's very important to be aware of the ownership level of the insiders before the foundation adds its money to the pool.
Yeah, terrific point, Jonna. I know that when we're working with our clients, we want to make sure that above everything else, we're taking into consideration making sure that they're staying compliant. Because as we touched on earlier, there's really no benefit that trumps the means to being in compliance and all of the due diligence associated with the investment. So you touched on this a little bit, but specific to ownership limitations, I know that there's also considerations around co-investment. Many of my clients that I've worked with who do a lot of work, especially in the private equity space, think that it's kind of a win-win, right? They want to really, they feel like they've done a terrific job on the private equity space in maybe their own fund that they're running. So why would we not maximize the private foundation's investment in that fund as well? My personal equity does better, the private foundation does better. It's kind of win-win for everyone. Why is that not such a win-win for everyone?
Well, so like I mentioned earlier, the ownership levels of an insider can make the entity itself a prohibited transaction partner, but also foundations are limited in their ability to own over a certain percentage of an active business enterprise. So if there are startup companies or partnerships that are considered active in nature as part of these funds or as a direct investment, a foundation and its insiders are not allowed to own more than 20% total ownership. Otherwise, you have an excess business holding concern, which would result in violations and penalties, which we want to avoid.
Right. No, that's a good point. I know you're going to talk a little bit more about this when we bring up the tax considerations as well. However, like I mentioned before, I think that some things that on the surface seem like they would never be a challenge are precisely the areas that you and your team help guard our clients against. So, Jonna, I know that's something that Ben brought up a moment ago that's very important as well, is being mindful of a private foundation's minimum distribution requirement, or as we commonly see it referred to as the MDR. Talk a little bit about why it's important to consider liquidity in investments to make sure that this distribution requirement is met.
Sure. So every private foundation, as you mentioned, has an annual minimum distribution requirement that they're supposed to meet in making grants or other charitable distributions throughout the course of the year. That 5% amount is determined based off of your investment asset average from the prior year. So any asset that you hold as a private foundation as an investment gives rise to an approximately 5% distribution requirement. So you need to have, number one, the foresight to plan for the following year, because your distribution requirement in any given year is based off of the prior year's assets. And you need to make sure that you have a steady cash flow in order to meet those distribution requirements, because a private foundation that holds an illiquid asset still has to meet the distribution requirement that's attributed to that ownership.
Right. And I know one of the challenges that we try to guard against is if you're too overweight in something like a tangible asset class, then you could risk the means to needing to actually liquidate one of those assets in order to make the minimum distribution requirement. And for a lot of people, they don't want to have to do that. So making sure that you have a balanced approach can be very beneficial for most private foundations.
And it's a good thing you bring up the balanced approach, because in addition to the considerations about self-dealing, excess business holdings, your minimum distribution requirement, often the forgotten compliance aspect is the jeopardizing investment concerns, which private foundations are required to be mindful of. Again, there's no specific investment type that is prohibited, but a foundation needs to make its investment decisions with a mind towards, number one, protecting the assets of the foundation, and also being in compliance with state level investor requirements, which include a duty to diversify.
Yeah, it's a really good point, Jonna. Perfect. So thank you both for talking through a little bit of the strategy. So I thought next we would move to a little bit more of an open format, asking some questions both of you, Ben, and of you, Jonna. And if either of you would like to comment on the other's question, please do so. I know we love to keep these webinars conversational and not driven by a lot of slides on the screen. So let's move through some questions about strategy. So Ben, most foundations invest primarily in liquid assets, equities and bonds, yet most foundations also have a long-term view on these assets. So why would a foundation want to consider illiquid strategies such as private credit or venture capital and private equity opposed to a more standard liquid asset approach?
Yeah, so this goes back to what we just talked about it's a couple of things. It's the preservation of capital and maximizing the ability to give, right? The power to give over time. And it's also about the 5% spending policy, right? So I think there's a misnomer around the need for, or rather the excessive need for liquidity inside foundation portfolios to meet those targets. So let me give you an example. So if you have a strategy, let's say within asset-backed private credit that has an illiquid profile, so it's a capital call structure, the capital gets called down over 18 to 24 months and gets invested into a portfolio of senior secured asset-backed privately negotiated loans. That's an illiquid strategy. However, that strategy distributes anywhere from 9 to 15% annualized on a quarterly basis, right? And it also does so with a high level of predictability and very little, if any, correlation or reliance on the market or spread compression to perform, right? So that's an example of an illiquid strategy that's going to help you meet that 5% without impacting the performance of your portfolio and without relying on the market to perform. In terms of equities versus bonds, I think I've been clear that we're really not at all constructive on fixed income assets today. There's very little reason, in our opinion, to own fixed income assets, given the fact that we believe that over the next 2 to 3 years, you're going to see a significant normalization of rates. It's anyone's guess whether the 10-year ends up at 3% or 5%. But my old boss always told me that the 10-year should be trading at nominal GDP, which if you take a growth rate and assume it's very conservatively 3%, and then you take inflation, which I think very conservatively right now, okay, over the next 5 years is probably going to average out at 4. Okay, so that's a 7% 10-year. Now, I'm not saying the 10-year is going to get to 7, but you can imagine the impact that will have on fixed income assets. We're pretty constructive on equities, certainly relative to fixed income. And so when we think about asset allocation for foundations, it isn't so much saying you need to get out of all your equities, but it is saying, let's think about how we can replace your fixed income allocation within a foundation. And what would you replace that with? Well, in our opinion, you would replace that with asset classes like asset-backed private credit, real estate, real asset leasing strategies, less correlated strategies such as litigation finance, maybe multi-strategy hedge funds, where you get a higher predictability of returns, and a good chunk of that allocation is actually going to distribute yield, which is going to help you meet your 5% spending policy. And then if you look at your equity allocation, certainly a chunk of that can be in liquid, publicly traded equities, whether that's ETFs or single stocks or mutual funds or whatever. But there's also an argument to say, well, if we're taking a long-term view, why not have some allocation to private equity? Why not have some allocation to venture capital, where we can take a long-term view, generate 20 to 30% type IRRs over a 10 to 15-year time frame?
Yeah, I think that's great strategy, Ben. So I know you touched on kind of my next question, which was going to be a little bit of your opinion on fixed income strategy, but we don't have to spend too much time there, as you kind of nailed that already. Jonna, anything in response as far as some considerations related to what Ben's talking through that we would want to be mindful for our clients or those exploring a foundation?
Sure. So, I mean, a couple of the things that Ben has touched on are actually, really important considerations for foundations. And again, the focus on liquidity is not to say that you have to keep your foundation's assets in, readily available cash on hand. It's just a matter of being mindful of your assets, the shifts in the assets, and, be future looking towards the performance of your portfolio. Something also that foundations, need to be aware of is, we usually encourage foundations to avoid taking out debt in order to acquire investment assets, because that could give rise to unrelated business income tax due to acquisition indebtedness. But if a foundation finds itself unexpectedly or, in a position where in the short term they are, in need of cash to meet operational or grant making or charitable needs, the foundation can always take out a short-term loan to bridge the liquidity needs to meet a 5% distribution requirement, and then reevaluate its position in the new year.
Yeah, great point, Jonna. So Ben, talk a little bit, I know you touched on this already, but talk a little bit about what areas of alternatives you think fit best within a private foundation's asset allocation based on the opportunity set specifically today in the marketplace that we're in.
Yeah, look, this is and we always approach asset allocation investments in a dynamic way because the environment shifts, the opportunity sets shift. But just from a high level, we always try to back into what result are you trying to achieve, right? And if the result you're trying to achieve, let's assume, is to insulate and protect the corpus of the foundation, grow it at a reasonable rate, and meet your distribution requirements, then for us, there are certain strategies within alternatives that make a lot of sense. One is private credit, and private credit is to me, it's a not a very well understood asset class because it's shifted and changed a lot since the GFC. So the private credit markets exploded after the global financial crisis. Billions and billions of dollars went into the private credit markets. And if you go back to 2013 to sort of 17 timeframe, a lot of those strategies were in direct lending, right? Direct lending to, medium and large size companies. But those loans were generally backed by cash flow and receivables. That market became really crowded, okay? And you had a lot of what we refer to as credit pretenders that were attracted by all the capital flowing into private credit. And you started to see covenant-like loans, you started to see leverage upon leverage. And so we really, starting in sort of 2016, 17, when you started to see rate compression, we started to get away from the direct lending asset class and focus more within private credit on what we refer to as asset-backed lending. So to us, to make it very simple, an asset-backed lending strategy, an example of that would be a manager that's going to make over a course of 2 years, 15 to 20 privately negotiated loans. These would be senior secured, top of the capital structure, and they would be collateralized by some form of hard asset collateral, which is often real estate or some other form of hard asset that can be valued, right? So these tend to be, asset heavy businesses, right? And the loan to value on the senior secured loan facility can be around 50%. So if you think about that, you're the top of the capital structure, you're the first money out, you're getting paid a double-digit yield for that credit, and you're protected at a 50% loan to value by the assets underwriting those loans, okay? And, for us, that strategy has generally produced somewhere between a 10 and 12% return, which is distributed on a quarterly basis, right? So think of 3 to 4% a quarter. Another area that we think is really interesting is what we call real asset leasing strategies. So think of owning a portfolio of 40,000 rail cars. Okay, rail cars are one of the cheapest ways to move non-discretionary goods around the country. So we have a manager that owns 40,000 rail cars. They have a very diversified group of lessees that will lease these rail cars to move their commodities around the country. That portfolio generates around a 7% yield and a 10 to 12% total return. We have the same thing in barges. Believe it or not, I've had to get up the learning curve very quickly on how the inland marine barge leasing industry works. And we have a manager that owns 1,600 what they call massive floating bathtubs that move non-discretionary goods up and down the Mississippi. So think of corn, soybeans, petrochemicals, oil and gas. And again, it's one of the cheapest ways to move these goods around the country. The yield on that portfolio today is 11.6% net to investors. Very little, if any, correlation to the market. You get inflation protection because you benefit from increases in wage costs, increases in steel prices on the NAV of the portfolio. Other areas that are of interest to us within real estate are, triple net lease, single tenant strategies, right? So we have a manager that owns a portfolio of, tier 1 buildings where the tenants are companies like Apple, Palo Alto Networks, San Diego Gas and Electric. That portfolio produces a 6% yield, and it's essentially like owning the corporate bonds of those companies because these tend to be mission critical assets for them. So like for Apple, it's their second headquarters, and these are 12 to 15 year leases that they own on a triple net lease basis. And then within private equity and venture capital, we have a really strong stable of managers within PE and VC. And again, we're big believers in innovation within both technology, healthcare, and biotech. But we think, like, if you look at the biotech industry, if you've been invested in public biotech markets over the last couple of years, you've been absolutely destroyed, right? And the problem is that the world overestimated the impact of biotech over the last couple of years because of COVID, and they've completely underestimated the impact of biotech over the next 10 years. And so we're big believers in innovation, but we like to represent that exposure in portfolios within private strategies that are not going to be beholden to the machinations of volatility in the public markets.
Yeah, I think it's a terrific point. Jonna, anything to add there?
Yeah, that actually brings up three really important, points from the private foundation planning and compliance side. First of all, anytime a foundation is going to be in a position where it owns things that either people will be coming and going from, like rented property, or where the foundation may be facing a more heightened liability exposure. Something many private foundations consider doing is setting up a single member disregarded LLC. And so for federal tax purposes, the LLC is considered one and the same as the private foundation. So all of the financials and everything ports through to the foundation's return. They're indistinguishable from each other. But on the state level, provided they're operated as two separate entities, you have a little bit of protection. So, if a barge sinks and somebody wants to come after the owner or the one who's responsible for leasing it out, the foundation's main corpus is a little bit protected if they have that LLC structure in place. The other thing that all of this brings up is, I mentioned just briefly earlier about active businesses giving rise to excess business holding concerns, but also unrelated business income, which is taxed at the higher for-profit corporate tax rates instead of the 1.39% excise tax rate that most private foundation investment income is taxed at. When you're dealing with passive source income streams like rents, royalties, interest, dividends, things like that, all of that is going to be exempt from the unrelated business income tax, as long as you are not taking out debt yourself as the foundation to finance that investment activity. So that's actually something that, a lot of foundations could utilize if they're adverse to having that unrelated business income tax exposure.
Yeah, that's a great point. Thank you so much, Jonna. And I want to spend a few more moments talking about the minimum distribution requirement, right? The 5% MDR, both from an investment standpoint, as you've brought up a couple of times now, Ben, but also the idea of taking an active approach and actually managing that 5% minimum distribution requirement. So a few things that we know about the MDR, right? You're required to meet it, like Jonna mentioned, even non-dependent on how that asset allocation is made. There are some strategies like program-related investments that can take a more active approach in that 5% management. However, when we think about that 5% minimum distribution requirement, it also comes with a 5-year carry forward, right? So for example, if a private foundation wanted to take a more active investment strategy to really try to get right on that 5% minimum distribution number, they could potentially go maybe a little bit higher on a really strong performing year, knowing that they can potentially pull back on a year that's not going to be as active. Talk a little bit about what we see some of our clients doing, Jonna, as related to this strategy.
Yeah, so this is going to be the first of many times I say this during this presentation. When you've seen one foundation, you've seen one foundation. Some foundation clients of ours are incredibly focused on staying very close to the 5%, not granting any more than necessary, maybe having a very small cushion, because they feel like that's the best use of the foundation's money, is to leave the corpus basically untouched. Other foundation clients are really more focused on what feels right in a given year for their mission. And that can have, unintended benefits where they've granted very heavily in a particular year. Either they were, cash heavy, or there was a particular project that required some significant funding and the foundation felt it could step in and serve that purpose. That 5-year carry forward, regardless of why you have it, is there to meet your foundation's needs. Something else that foundations can consider using excess grant carry forward. If you're a foundation that grants well in excess of your 5% distribution requirement repeatedly, there's a chance that you could lose your 5% payout. Carry forward, it expires after 5 years.
Right.
So some foundations use this as a planning tool to take the conduit election. And the conduit election is something available to private foundations that are willing to meet a very accelerated distribution requirement that allows you to take, instead of the cost basis deduction that you're entitled to as a donor for most alternative assets, you would be entitled to take a fair market value deduction as if you were a public charity. So basically, if I make a donation in 2022 and I would like to be eligible for the conduit election, I need to be able to meet my 2022 payout requirement, my 23 payout requirement, and redistribute the full amount of the assets that were contributed into the foundation in the conduit election year. It's a high bar to meet, which is, something that, many foundations are intimidated by or are not able to meet, because otherwise they'd have to just redistribute a large portion of assets that they would like to hold on to. But if you have extra distribution carry forward, it's a worthwhile strategy to consider.
Yeah,
that's a great point. No, please go ahead, Ben.
I mean, it's funny. I always say to the guys that work with me, I learn something new every day. And I actually didn't realize that the 5% was on the previous year's value. So like, if you think about that for a second, like, let's say you had a great year and then you come into a year like this and the market's down 30%, your 5%'s on last year's performance.
Yeah.
So like, that's a really important, because suddenly that 5%'s like 8%, right? And so that to me makes an even stronger argument for investing in asset classes that can distribute that 5% versus having to rely on continued market performance going forward.
Yeah.
And something else to consider, especially in places where you're looking at investments like the biotech that you were talking about earlier. If a case can be made that the investment is really for charitable means, like you're trying to develop a new, technology surrounding, drug treatment or, a vaccine or something that's, innovative, and you can work with private foundation attorneys who can help put together a program-related investment expenditure responsibility investment agreement. The foundation gets to have that asset on its books as a charitable use asset, exclude it from your asset average for purposes of calculating your distribution requirement. The distribution counts as a qualifying distribution. And just because the investment ends up doing well, if it does well, doesn't negate the fact that the reason you made it was for charitable purposes in the first place. You don't have to reclassify the asset just because it's successful.
So that's fascinating, because, I mean, I can tell you one of our private biopharma funds, they had an investment in BioNTech, which, as you guys know, partnered up with Pfizer to create the Pfizer vaccine for COVID. Yeah. So the ability to have that investment count towards your spending policy is fantastic.
Yeah, I work with foundations a lot, and I explain that if you're willing to put in a little bit of money up front with an attorney to put in the right terms in your investment agreement and do everything that you need to do from the expenditure responsibility side and document the charitable purpose, it really benefits you, because, those investments, for every one that, falls flat, there's another one around the corner that's going to turn out to be the next big thing.
Yeah, it's a really strong point, Jonna, and I know that we can continue on this thread for a long time, because it's incredibly interesting. I'm going to move us forward a little bit. However, I'm going to kind of keep us in that same vein. So I'm going to say it for you this time, Jonna, but to that concept of you've seen one private foundation, I kind of cringe every time I say it, because it's a little bit cheesy sounding, but it's so true in our space, right? So talk about the idea of appetite for risk within private foundations, because on one degree, as you mentioned before, some private foundations have are laser focused on their private foundation existing in perpetuity and have a multi-generational legacy plan and really want to stay as tight to that 5% minimum distribution requirement while increasing their asset base, because they want their foundation to be around for a very, very long time. Well, I would say that the majority of private foundations tend to have a focus on perpetuity and next generation strategies. many other foundations do have a sunset provision or a spend down plan. Some of the largest private foundations in the United States have a spend down plan in place. And there kind of seems to be this push pull between making sure that you're returning enough on investment for your foundation to exist into perpetuity, while also making sure that you're doing the great work that you set up to do out of your private foundation and getting those assets and resources into the hands of public charities and into the hands of recipients to further the mission that the foundations care about. So talk a little bit, I know that was a mouthful, right? But talk a little bit about kind of the idea of risk and how we see risk looked at both within private foundations, outside of how maybe an individual investor might consider risk, and vice versa.
Yeah, so I mean, really the big thing is for as dense and complex as the IRS rules that are around private foundations look from the surface, they are really designed to be as specifically vague as possible. Private foundations are given just enough, information to be dangerous. The IRS loves to say, well, you could do this, but we're not going to tell you how. So some foundations see that as a fantastic opportunity. They say, well, they didn't say I couldn't do this, so let me just figure out what that looks like. And some foundations find it to be limiting because they are very averse to risk and they don't want to open themselves up for any possible scrutiny. And what I've seen over the last 10 years here at Foundation Source is, there's no wrong way to approach your foundation. If you're not comfortable, being on the cutting edge and the outskirts of the rules, that's fine. There are plenty of ways to navigate your foundation, your investment strategy, your philanthropic mission that are clearly within the boundaries, no question about it. But there's space on the edges for foundations that, really want to explore opportunities and be innovative with their philanthropy. And something else that we see a lot of foundations, more so now than ever before, they want to make this a full-time job. It's not just, something to do on the weekends where you cut a check and forget about it. There are people that are dedicating their entire time and effort into running a foundation. And the fact that there's so much leeway for what that can be, makes it really exciting for people that want to focus their energies on doing this.
Yeah. So thanks, Jonna. And Ben, I've had clients who've said, pertaining to risk, I would do this type of strategy. I would never do this type of strategy with my individual portfolio, but let's explore this within a private foundation, right? Maybe they do want to take a bit more of an entrepreneurial approach, and they'll take on a higher risk appetite out of their foundation. What have you seen some of your clients do in that case?
I'm actually surprised how ignored some foundation portfolios are. A lot of folks that we've worked with and we've spoken to, some of them, as you say, are very engaged, but they're engaged in the giving. They're not engaged in the asset allocation of they almost ignore the asset allocation within the foundation versus their taxable accounts, right? But you can absolutely make the argument that risk appetite within a foundation that should have a very long-term view can and should be higher, but let's also be intelligent about it and not invest in asset classes that simply don't make sense, like fixed income today, right? And I also think that there's I think that liquidity doesn't mean less risk. And I think a lot of people feel comfortable being in liquid assets, but it gives them a false sense of security, right? Because they feel like, well, if the market's not going my way, I can always get out. The reality is that doesn't happen because investors tend to be much more reactive than they are proactive. What we're trying to get people to do is to be proactive and look at the investment landscape and say, okay, I will admit that owning fixed income assets today just simply doesn't make sense. Okay, and there are other asset classes that make a lot more sense, that have a much higher level of predictability, that generate significantly higher multiples, higher returns than you're going to get in fixed income assets today, without having to experience the kind of downturn that you would see from a normalization of rates. But in terms of risk appetite, the risk appetite should be higher in foundations, but I think that ends up getting skewed by the need for liquidity or the comfort that liquidity provides investors.
Yeah, it's a really good point. So, Jonna, anything to add on that? I know we could spend an entire separate webinar talking about strategies like program-related investments and mission-related investments and how all of those really take into consideration risk of private foundations, largely for the right reasons, right? But talk a little bit about kind of what Ben mentioned before.
Sure. So, I mean, private foundations that look to impact investing, mission-related investments, program-related investments, again, this is all going to be the same as any other type of investment. It could take any form as long as it's within the foundation's mission for a program-related investment, furthering their charitable purposes. The benefit of, in particular, program-related investments, because mission-related investments are really more in line with standard investments. They just align more closely and allow the foundation to explore somewhat riskier options. But program-related investments are like renewable money that counts towards your payout requirement. So like if you make a loan, let's say even to a public charity for a nominal interest rate, it's not going to bring in, massive returns, but it gets treated like a grant when it goes out the door, and it does generate some small, modest income stream. So especially for smaller foundations that are looking for ways to be sustainable and have longevity without, putting their foundation's corpus at significant risk, that can be a toe into the waters of alternative investments that really pays big dividends to the foundation, because it provides them with an opportunity to continue to benefit the organizations that they want to without just sending money out with nothing coming back.
Yeah, it's a great point. And again, I don't want to take us too far down the road of program-related investments because it's kind of a passion of mine. As you know, there's a lot of people in the private foundation space that really believe that program-related investments are kind of the future of structured philanthropy. So we'll save that for another day. Thanks for that hand raise there, John. That's terrific. But again, we won't spend too much time. I do want to touch on a couple of additional asset classes that we haven't spent a lot of time talking about today. And again, they could probably have their own session as well. But let's start first with cryptocurrency, right, Jonna? We've had a lot of clients reach out, especially in the last year or two, exploring cryptocurrency type contributions and investments within their foundation, as well as other digital currencies as well. Talk a little bit about kind of the IRS's perspective on cryptocurrency and digital currency and how they're treated in the eyes of the IRS. And then something specific to what Ben mentioned earlier, talk about the strategy of how the large swings in cryptocurrency can affect the consideration related to a minimum distribution requirement.
Absolutely. So the IRS notoriously slow to keep up with innovative developments in really anything, but they consider cryptocurrency to be property. So it's the same as donating a piece of real estate or a piece of art or anything else to your foundation. Donors entitled to the lesser of cost basis or fair market value for their charitable deduction. And if it's worth more than $5,000 at the time of the donation, you're required as a donor to file Form 8283 to substantiate your charitable deduction. The foundation now holds this asset and it's considered property by the IRS. And usually alternative assets property is valued once a year for purposes of calculating the MDR. And because of the volatility of this particular market and this space, that could really come back to hurt a foundation, because if it happens to be on a huge upswing on the day that you value that asset, that's it. That's your value for the year. So actually Foundation Source worked closely with our own outside counsel and our chief legal officer, and everybody here kind of put their heads together and looked at the regulations that apply to cryptocurrency and the best way to approach this in the spirit of the regulations and not to expose our foundations to any unnecessary risk, but also to try and come up with a better way. And actually, for purposes of MDR calculation, the way we handle cryptocurrency for foundations that we provide services to is to value them the same as publicly traded securities. We look at the end of month average, the closing value, and do the average over the prior year's span, either the full 12 months or prorated based on when the asset was moved into the foundation, and have found this to be a more equitable approach to calculating the value of cryptocurrency. This is only for purposes of MDR calculation. So if a foundation has a cryptocurrency or other, NFTs, anything like that, and sells it, we would look at the value on the date of the sale and, calculate gain or loss based off of that value. And actually something just to be mindful of, if you do turn around and donate cryptocurrency to a public charity out of your private foundation, your private foundation is entitled to a fair market value qualifying distribution as of the date of the contribution, which is another tool that foundations can use to help kind of navigate that volatility in that space.
Yeah, terrific. Ben, anything to add on that topic?
Yeah, I think, obviously the only value I can add is from an investment perspective. We've spent a lot of time, and again, I think it's a misuse. The cryptocurrency to me is almost, it's a statement that doesn't make a lot of sense, because it's become an ecosystem, right? You have digital assets, you have platforms, you have blockchain, you have the Bitcoins of the world, the Ethereums of the world, right? Which are these publicly traded, highly volatile investments, right? So taking those separately, if to simplify it, you take Bitcoin and Ethereum, okay? To me, you have to think about that from a diversification perspective. How much Bitcoin and Ethereum does it make sense to hold within a portfolio, right? And an asset allocation framework. Our opinion is, given the current state of the volatility within those asset classes, a reasonable allocation is somewhere between 1% and 3%, okay? However, if you look at blockchain, which to me comes under the vertical of venture capital, that's investing in companies, private companies that are within the blockchain ecosystem, where we have a strong belief will continue to disrupt almost every incumbent industry in terms of removing frictions for trade, disintermediating middlemen, identifiable and trackable ledgers for different industries. That can have a reasonable allocation within the portfolio, and by the way, not experience the kind of volatility that you're going to see in the traded cryptocurrencies like Bitcoin and Ethereum. Back to when I was running the family office, 2013, we got involved in Bitcoin. And when I described it to the patriarch, I said, look, the way to think about this is something that you should invest an amount of money in that you literally don't care if it goes to zero, and forget about it for the next 10 years. And do not, whatever you do, look at it on a daily basis. Because the swings in these markets are almost incomprehensible. And I think that's the way you have to think about this asset class. Now, today, the digital asset space, as I like to call it, is come a long, long way in terms of adoption, acceptance, the size of these markets. You look at the Bitcoin market today versus what it was 5 years ago. It's huge. So, what's really interesting about this space is that the institutional adoption of digital assets is still in its infancy. I just came from a seminar in San Francisco where a number of very large institutions were talking about the fact that they've come up the learning curve in digital assets and cryptocurrencies, but they haven't put a dollar to work. So my guess is you're in the second inning of institutional adoption. And so I think we're getting to a point now where advisors like us that are advising families and foundations, whereas a couple of years ago, it was maybe irresponsible to suggest investing in these asset classes, we're getting to a point where it's becoming almost irresponsible not to have some exposure to these asset classes. The key is how much exposure should you have in your portfolio, and in what vehicles, whether it's within, venture and blockchain or, the traded currencies.
Yeah, great point, Ben. And I can't help but laugh when I hear you talk about your 2013 strategy related to digital currency. And I think about my strategy when I'm maybe going to Vegas, right? You're only bringing enough to where you assume you're going to lose. So So listen, Jonna, Ben, I know we're getting really tight on time here. I meant to leave a lot more time for audience questions as I can see them coming in. In fact, I think I got about 10 to 15 questions sent to me before our panel even opened today. So I'm gonna just touch on one or two, and then I'm gonna ensure everyone that we will certainly follow up on everyone's question after this session concludes. We will be making this recording available. If you did register and you were only able to join for the first half or the second half, we will certainly make sure that you get a hold of the presentation as well. So the first question that I wanted to, and again, I'm picking one that I know that we could do an entire additional session on, Jonna, but you brought up something specific to real estate earlier that is very important, right? That real estate as an asset class can be viewed as two different ways within a private foundation. It can be looked at as an active investment strategy, i.e. you contribute an income producing apartment building to your foundation, and that income that's generated is treated as an investment of the foundation and returns to the foundation. But real estate can also be used as a charitable use property. So it's a little bit unique that it can be classified one of two ways. And it's really important for our clients to understand that, because real estate is so dynamic, especially, not limited to California anymore, right, where we are, Ben, but really across the entire United States. And it's a polarizing type of investment. But talk just for maybe 60 seconds, Jonna, about the difference between a investable or investment asset and a charitable use asset.
Yeah, so an investment use asset would be, again, included in your asset average for purposes of calculating your 5% payout requirement. Any income stream would be investment income, and any expenses associated with maintaining or improving the property would be considered investment-related expenses and would go towards calculating your net tax liability. You find a way to treat the real estate as charitable, foundation offices, for some charitable program, meeting spaces, bee pollinator project, whatever. All of the expenses associated with the property, in addition to the purchase price of the property, if the foundation were to buy it directly, would be considered qualifying distributions and go towards meeting your payout requirement.
Yeah, perfect. Thank you, Jonna. And one in closing for you, Ben. This has come up as I kind of scanned through some of the questions that we received live. But I think for a lot of people, you touched on before, right, the idea of passive investment. For a lot of people with private foundations, this can be a little bit overwhelming. This all sounds amazing, and it can be kind of, why haven't I done this for the last 20 years in my foundation? When you're speaking to people who maybe want to get started with this type of approach for their private foundation, but don't want to do a cannonball into the deep end, what are some of the things that you talk to clients that are exploring these types of investments about, and maybe talk a little bit about how clients can bring up this concept with the advisory team that they're working with?
Yeah, look, we started this firm because unless you're going to just go and allocate to the very large asset gathering alternative managers out there, like the Apollos and the BlackRocks and the KKRs, which, by the way, fantastic firms, but in our opinion, not the best risk adjusted returns versus the industry. Our view is that if you're going to invest in the alternative landscape, it can be a daunting and overwhelming project to take on, because you really do need to know what you're doing. But I think that we're facing, in my opinion, the lowest prospective returns from traditional asset classes that we've ever seen going forward. Okay, you can certainly make the argument that equities look favorable versus fixed income, but even equities, you can make a pretty good argument are overvalued and going to struggle to produce anything like the returns they've produced over the last 15 years. So I think alternatives have to become a consideration. And, I think this is something that foundations should be discussing with their advisors. The problem is that many advisors out there don't specialize in alternatives, and they don't necessarily have the tools to source and underwrite alternative strategies. So it's not a simple problem to solve, but you also don't. I think the problem with alternatives is that the preconceived notion is that it's risky. And I think if I can get one message across to our audience today, it's that alternatives can be significantly less risky than what you face in equity and fixed income markets today, whether it's in private credit, real asset leasing, real estate, that we've alluded to during the course of this conversation. You can build a portfolio that has a much less risky profile than a traditionally allocated portfolio.
Terrific. Ben, thank you so much. I know we're at our time right now, and judging, like I mentioned before, by the questions that are coming in, we'll have lots of follow-up discussion for this. You can see the contact information on the screen here. If you do have a specific question but weren't able to ask it during the course of our webinar. Ben, thank you for being such a terrific partner. Jonna, thank you for being such a wonderful resource to our clients and our prospective clients. We'll certainly be following up with more sessions like this. But for today, thank you everyone for joining. It's been a pleasure, and we look forward to staying in contact soon. Take care.
Thanks, guys.
Bye-bye.